What's going on, penny boys and gals? It's your boy, What the Duck here, and it's time for another trading class video. Last week we went over candles. This week we'll be starting to go over indicators. I know that indicators are the fun part of trading, but it's important to know the basics of trading first, meaning having an understanding of trading psychology and trading strategies, as well as understanding how Pennybois alerts and the Discord works, and of course making your own Pennybois University trading plan. So if you're new to the Pennybois University trading classes, I highly recommend starting from the beginning. We will be resetting the courses in 3 weeks. We're going back to week 1, so you'll be able to follow along live then and be a part of the live streams as they happen. But for now, at the very least, just check out the first 2 classes so you can familiarize yourself with the Discord and the Pennybois alert service, and then of course you'll be ahead of the game when we do our reset. So what are indicators? Indicators are mathematical equations that take into account a stock's price or volume. They are used to help traders determine possible supports, resistances, trend lines, or reversals. There are many ways of looking up indicators on charts. We went over Finviz, Webull, Robinhood, Investing.com, Investopedia, TradingView during our trading tools class. Today we'll be going over some of the charting features in Investing.com, TradingView, and Webull in a little bit more detail. So here you have the chart for Apple in the desktop version of Webull. So you have your 1 minute chart, so you can change, 3 minute, 5 minute, 10 minute, and like we went over in the last couple candles classes, each candle is going to represent either 15 minutes, 10 minutes, 5, 3, 2 minutes, a minute, a day, depending on what you select. That's how the candles work. So we're going to go ahead and show you how the indicators work. What you're going to do is you're going to go up here to indicators and click that, and this will show you some of the frequently used indicators. So if you are currently using the site, you can also go to all indicators. It'll show you some more, or you can go to edit indicators, and this is how you edit your different indicators as far as the length of the moving averages goes, or the standard deviations of the Bollinger Bands, all the different settings basically of each indicator. And we'll be going over what the standard deviations and the period means of Bollinger Bands, period meaning the moving average, but we'll go over that in a little bit of detail later today. So these are all your different indicators. It'll tell you what, KC, it means Keltner channels. It tells you that right here. And these are also how, this area is how you set your different moving averages, your different, your VWAP, what you want this is how you set all the different settings and, change all the different lengths and widths and all the other stuff that goes into each indicator. So that's under indicator settings. We will be going over some different indicator actual settings, like some different ones that we use, some that Big Quench uses as far as the actual settings go. We'll be going over that in the next couple classes once we start going over indicators. But for now, this is how you get into the indicators. You just do that, edit indicators. You can do all indicators or edit indicators, and then you can just click your indicators if whichever ones you want. So that's how you find the indicators in Webull. You can also go to investing.com. You can search a stock. So we got Apple. Once again, you can do you can do the 1 hour, the 1 day, the 1 month. You can do the 1 minute. If you click this, you got your hour, all that good stuff. And then you just go to indicators, which is right here. So you click that, and it has all the different indicators there for you. So if you want Bollinger Bands, you can get the Bollinger Bands. You don't want them anymore, you just go up here, you exit out of them. If you want to, let's say you have your Bollinger Bands, you want to change the settings of the Bollinger Bands, you just go to that little settings tool, a format tool, and you can change the length and the deviations and all that of the Bollinger Bands if you want to change the settings. So that's how investing.com works. So let's go ahead and I'm going to show you how the Webull app works. So with Webull, you're going to go to the top right corner of the screen. It's going to be right underneath the volume, and it'll show you all the different type of moving averages, EMA, which is the exponential moving average. All the different types of indicators are going to be listed there. You can go to more, and it'll show you even more indicators. They even have some of them in different categories, such as moving average indicators, support resistance indicators, and all that other kind of good stuff. So you can kind of see, what certain indicators show you resistance, support, what indicators might show you a trend reversal and all that. And that is how you go into the indicators. All you're going to do in that app, once you're in the indicators area, once you go to more, from there you can edit all of your indicators. You can also do trend lines in Webull app button. You're going to go to draw, then you got your trend line. Click with your finger onto 2 different areas. You can drag them around, and that's how you create different trend lines. If you want to create a channel, which are 2 trend lines, you can just do the same thing. You just go to draw trend line, and then you click it like that, and then it's gonna be a channel. And like I said, you can just click one end of the line, the trend line, and just move it. So now you have two trend lines, which are making a channel. So that's how the trend lines work in Webull. That's how the indicators work in Webull's app. And then you can also do trend lines in desktop. Go to drawings the same way as you would with the app. You're just going to drawings, you go to trend line, or you can go to a low and go up. There's one trend line. Let's say you want to make a channel, two trend lines equal channel. Now you got your channel there in the 1 minute. That's how the trend lines work. It's you can play around with them. They have different versions. You can do like just an actual trend line. You can do vertical lines, Fibonacci. You can do polylines and all this other stuff. You can go to investopedia.com. You can also just go to the trend line right here, and you can make the same exact line as we just did before. So kind of same deal as we did in here. So this is really up to you if you want to use investing.com, or you can use the Webull.com. You can use Webull app, or you can use TradingView. One thing I like about TradingView, you have your indicators, you have your trend lines. So trend lines here, indicators here, but you also, under indicators, you can do candle patterns. So remember those candlestick patterns we went over before? Well, what you can do now is, you can find different ones. So you just click the patterns and it'll show you when it's happening. So this is a good way of researching different candle patterns as well, because it'll show you, where they all are, why they are what they are. So that's why I like TradingView for that. So once again, that's under indicators, candlestick patterns, a good way to look up candle patterns. So tonight we are going to be going over indicators that can show us a stock's support and resistance. So I'm going to give y'all a chance to pull up the indicators that we're going to be going over today. So try to find Bollinger Bands, BOLL, MA, or sometimes is SMA, depending on what site you're using, DC, ENV, Fib, LC, IC, and KC. So that's BOLL, MA, DC, ENV, Fib, LC, IC, and KC. You can find that on your app or whatever site you're using. If you're using Webull, you can put it into your main indicator so you can have it easily accessible during this class. For those of you new to trading, the reason that we do this is so that you can learn the basics of trading, but not only that, it's so that you can see just how much goes into trading. And I mean, PBU is just the basics, and even the basics can be confusing. Trading is hard. Trading is not easy. It's not something that you can just get into and be rich in a year. I just want everyone to know that even if you do these PBU courses and graduate and do the advanced courses, I can't guarantee that you'll be living on a yacht in a month or two or in a year. I can't guarantee you that you'll be making, 1,000% per day. I can't guarantee you rocket emojis all the time, or that you will never have a losing play ever again. If you want that, there are plenty of pump and dump scams or big time traders out there who will give you false hope and take your money. That's not what we're here to do. What I can guarantee you is that if you attend the classes, do the homework, and ask questions, you'll learn how to develop a trading plan, and you'll get the tools necessary to use for your trading arsenal to make sure that plan is getting followed through with. And hopefully you'll be a better trader than you were before these classes started. The goal is for you to become a better trader than you were a week ago or a month ago, a year ago. That's the only trader that you're competing against is your past self. And hopefully you'll learn a lot about trading psychology in these classes as well, so that you don't fall victim to what 90% of new traders do, which is just give up too soon, and in that sense they're losing out on future gains if they stuck to it and just learned, which is the hard thing to do. The easy thing to do is to give up. But that's what we're here for. We're here to become better traders for the future so that we can make bread going forward. I hope that you have all those indicators up on your screen, but first let's go over what standard deviation means really quick, as you're probably going to be hearing that term a lot in tonight's class. So standard deviation measures volatility in the market by using mathematical equations to find the difference between certain points, be it highs, lows, medians, so on and so forth. So basically, standard deviation helps us figure out the spread of a stock's price from its average price. So first up is one of the most popular is going to be the moving average. And we're going to go into indicators. So it's not under my frequently used. So I'm going to go, you can either go to all indicators, you'll have your moving average right here. So when it comes to finding support and resistance with moving averages, you can look at the price versus the moving average. So really quickly, when I say that the moving average shows you the average value price of a stock over a certain time period, that time period is dependent on what you choose as your settings. As I was showing you before, I did 5, 20, 120. So this is the moving average over 120 days, the average price over 20 days, over 5 days. And I will go over what all this means in the next moving average class, which is tomorrow. But for now, we're just going over support and resistance. So when it comes to finding support and resistance with moving averages, you can look at the price versus the moving average. If the current price is below a certain moving average, then the moving average can typically be looked upon as a resistance. resistance. And if the price is above the moving average, then the moving average can be seen as a support. The longer a moving average holds as a support or resistance, the stronger it is as a support or resistance. And you can use moving averages in many other ways as well, but we'll be going over those ways in tomorrow's class right here. So this is Apple. Apple's been above the 120-day moving average since April. So this right now is a really strong support because it's been the support for a long time. The stock hasn't gone below that support in a long time. So this is a very strong support. You also have this green line here, your 20-day moving average. So ever since here, it was used as a support, but then it broke support. And then it broke support again. So this is less strong, but right now you're using this as your support. Let's just say when it was trending down, here we go. But now, since these lines are above the price, these are now your resistance prices. And here it goes, it broke the resistance. Now this is your support. It actually bounced right off the support, bounced off the support. And when I say support, I'm talking about the 120-day moving average, so the yellow line. So it was using the yellow line as a support, broke down past the support. Now the yellow line is your resistance. It broke above, now the yellow line is your support, bounced off the support, bounced off the support. Now it's starting, this is starting to become stronger. Support, broke again, and then it came back up. Now that's your support again, and then right now it's currently your support. That's how that works as far as support and resistance goes, as far as moving average goes. Like I said, there's a lot of different ways to use these moving averages, like when they cross, and just other type of trends and stuff like that. We'll be going over that in the moving average class. Next up is the Bollinger Bands. So for Bollinger Bands, you're going to go to indicators, take off the moving average, You go to all indicators, BOLL, Bollinger Bands. In the 80s, John Bollinger developed this technique of using a moving average with two trading bands above and below it. It's not a percentage calculation like some indicators. The bands in this indicator simply add and subtract certain standard deviation calculations. Bollinger Bands have a center line and two bands, or price channels, which are above and below the center line. The center line is an exponential moving average, which is something that we'll be going over next class. Typically, it's a 20-day moving average. So this middle line right here is the same thing as your 20-day moving average. If I was to go to indicators and go to moving average, so the 20-day moving average would go the same as that middle Bollinger line. So that middle one right here is a 20-day moving average. Now you see right here 20, that means that you're using a 20-day moving average, and you're using the 2 is the standard deviations. This is your 20-day moving average, which is right here, and is 2 standard deviations above and below. The upper and lower bands are the standard deviations of the stock, and we went over what standard deviation means earlier. The bands will expand and contrast as the price action of a stock becomes volatile, which is when it expands, or starts to follow a tight trading pattern, which is when it contrasts. So when the lines are farther apart and the deviations are farther apart, that means that the stock is more volatile. It can go up or down, and it can go higher or lower. Whereas when they're really close together, it's less volatile. So like over here, it's just only going in between these channels. Whereas over here, it's going, it can go up and down pretty high. Like up and here, down pretty high. Typically, the upper and lower bands are 2 standard deviations either above or below the 20-day moving average. But those calculations can be modified. Like anything, if you go into indicators, you go to edit indicators, you can edit your Bollinger Bands and do different periods, different EMA, different standard deviations. So, just like anything in stocks, it's all based off of what you personally, what works best for you. Okay, so standard deviation means it's the measure of volatility in the market. So by using mathematical equations to find the difference between certain points, be it highs and lows, medians, etc. So basically that means standard deviations helps us figure out the spread of a stock's price from its average price. So that's what these standard deviations are. It's the measure of volatility in the market using the difference between certain points, be it highs or lows. So that's what the Bollinger Band is showing you as far as those standard deviations go. So basically the bottom band in the Bollinger Band here, the bottom band can be used as a type of support, and the top can be used as a type of resistance. So even here, as you can see, the bottom band, or top band here has been the resistance, and then, hey, now I hit the support, came back up to the resistance, hit the resistance, went back down to the support, hit the resistance, support. So these bands show you the top being the support, bottom being the resistance. So right here, is that its resistance, is a good chance it might come back down again. The Bollinger Bands is a very popular indicator, especially for short-term trading. Lots of people buy when the price crosses below the lower Bollinger Band, and they sell when it hits the top. So especially right here, they would buy, and then they would sell or put a stop, trailing stop loss once it hits that top. Buy, sell, buy, sell. It's really, really popular for day traders, especially when you use other indicators as well, hand in hand with that. And the Bollinger Bands can also tell you if a stock is oversold or overbought, but we won't be going over that in our oversold and overbought classes. This is just the support and resistance classes. Next up is going to be the Donchian Channels, DC. These are also 3 lines generated by moving averages, average calculations that have upper and lower bands around a middle band. Your upper and lower band around that middle band. This is calculated differently than the Bollinger Bands, however. The upper bands show the highest price of a stock over a certain period of time, while the lower band marks the lowest price of a stock over that same time period. The area between the upper and lower bands is the Donchian Channels, and Richard Donchian developed this indicator in the mid-20th century to help him identify trends. And fun fact, his nickname is the father of trend following. So super creative, right? So as you can see, so in this in-between is the Donchian Channel. You got your high, your low, and this is just based off of a certain, so this shows the high and low of a certain time period. So typically, as you can see, it stays in between these lines right here. The purple would be kind of like where the magnet that it draws back to it, you know, it keeps going up or down, but it keeps drawing back to that middle. So the point of this indicator is to identify bullish and bearish extremes that favor reversals as well as breakouts or breakdowns, which is when a stock either shoots up or tanks down. The middle band computes the average between the highest high over a certain period of time and the lowest low over that same period of time, resulting in a median or a mean price. So this is kind of like that middle, the in-between of these two. So right now the price is at that high, means that might be a resistance. As you can see, it's been a resistance. So there might, you know, I wouldn't really buy here because it might have some pullback first, unless you're a really long-term investor and you see a big uptrend just in general. But we are traders, so we want to get the best price possible. The top line shows the extent of bullish energy, and the center line shows us the median or mean price, and the bottom line identifies the extent of bearish energy. The difference between the Donchian Channels and the Bollinger Bands is that the Donchian Channels plot the highest highs and lowest lows over a period of time, while the Bollinger Bands plot a simple moving average, typically that 20-day SMA, for a certain period of time, as well as taking into account the standard deviation of a stock's price during that amount of time. So the Bollinger Bands use that 20-day moving average with those deviations, whereas the Donchian Channel uses the highest highs and lowest lows to determine its calculation. This is why the Bollinger Bands are a little bit more balanced, because it reduces the impact of a big high or a big low, unlike the Donchian Channels, which can be affected by a sudden drop or sudden rise in price. Next up is the moving average envelopes, also known as the ENV, which looks kind of similar to what we've been going over. Kind of looks similar to those Bollinger Bands or those Donchian Channels. A lot of these are very similar, but they are all different calculations, so they kind of show you different, like little different things. Not everyone uses all these at the same time. They might use just one. Like, maybe I only use the Bollinger Bands out of all these. Maybe I only use the Donchian Channels because everyone's different, and some people like one over the other. So the next is the ENV. So once again, this is a banded indicator with those 3 lines. ENV has an upper envelope above a basis line and a lower envelope below the basis line or center line. The basis line or center line is a moving average. The envelopes are set a percentage away from the basis line, depending on what percentage you decide to set it at. So once again, like most indicators, you can change that, to whatever you want it to be. So because this is a trend following indicator and moving averages lag behind the current price of a stock, which we'll get into more next class, the envelopes will as well lag behind the current price of the stock. ENV is designed to have the majority of price action occur inside the envelopes, so when price breaks through the envelopes, this is a sign of strength and can indicate a significant price move. For example, in a strong uptrend, a breakthrough above the upper envelope may indicate that the uptrend is strengthening and will continue. So it broke through that resistance. Although during a sideways trend, a breakthrough above the upper envelope may signal an overbought condition, which might cause the price to fall back within the envelope. So it hit that resistance and it went back down. So in this case, it hit the resistance, went back down. So in this case with Apple, those support and resistance indicators have been pretty strong. As you can see, it's pretty on point. So in theory, this might be your new resistance, and then this would be your support. Or you can use this orange line as even smaller support, with the resistance being up here. Because the price going above that envelope might mean one of 2 things depending on the trend, you have to be careful with this indicator. As with many indicators, a trick to using ENV efficiently and effectively is using this alongside other indicators and using the correct parameters, meaning settings. This is the difficult part. This mostly comes by trial and error as well as experience, which is true with most trading techniques, which is why paper trading will be your friend. And just because I like to use a indicator one way with certain settings, with other indicators doesn't mean that it's going to work for everybody. I will give you some settings that I personally use. I will give you some settings that Big Quench uses. during these indicator classes, but ultimately it's up to you what you decide to do. Just because I like to use a baseball bat that's a certain way doesn't mean it's a good thing for somebody else. We're all different. We all trade differently. That's really a trial and error kind of thing. Just like the trading plans, it's all based off of what what works best for you, and it's all trial and error. And the best way to do trial and error is with paper money, because it's not your money. If you're going to be practicing with money, you might as well practice with money that's not yours. Next up is going to be the Ikimoku Cloud. It's a collection of technical indicators that show support and resistance levels, as well as momentum and trend direction. You see, most of these indicators show more than just one thing. The IC, or the Ikimoku Cloud, takes multiple averages and plots them on a chart. It uses these to compute a cloud, which attempts to forecast where the price may find support or resistance in the future. While it seems very complicated at first glance, those familiar with how to read the chart, or this chart, often finds it easy to understand with well-defined trading signals. But this of course takes time, patience, and practice. The Ikimoku Cloud is composed of 5 lines, or calculations. There are shaded in lines, which are called the clouds. Right here is the red and the green of the clouds. The lines in general include a 9-period average, 26-period average, an average of those two averages, a 52-period average, and a lagging closing price line. When I say period, it can be a minute, day, week, 30-minute, or whatever chart you're looking at, just like the candles, it's depending on what you are looking at chart-wise. The cloud is a key part of the indicator, so that shaded in part right here. When the price is below the cloud, the trend is down. When the price is above the cloud, the trend is typically up. The trend is strongest if the cloud is moving in the same direction as the price. For example, if during an uptrend, the top of the cloud is moving up, or during a downtrend, the bottom of the cloud is moving down. So this is a clear uptrend. It's green, it's going up. It's pretty strong. So basically the overall trend is up when the price is above the cloud, down when the price is below the cloud, and trendless or in the process of switching trends when the price is currently in the cloud. Right now it's actually just going above it, so it might have broken that resistance, might be showing you that it might be going back to an uptrend. The cloud provides support and resistance levels that can be projected into the future. This is the main difference between the cloud and many other technical indicators, because most of the other ones only show support and resistance levels for the current date and time or the past. This indicator, however, should not be used alone. It is often used alongside the Relative Strength Index, or RSI, which we'll be going over next week. And we also have the Kettner channel is the last indicator that we'll be going over before we get to the Fibonacci bands. They're super popular Fibonacci bands. The Kettner channel is a volatility-based technical indicator which shows 3 separate lines. The middle line is an exponential moving average of the price. Additional lines are placed above and below the EMA. This is just like the Bollinger bands and some of the other indicators that we went over earlier. That one term that this indicator uses is the ATR, or average true range. The average true range is an indicator that measures market volatility. The upper band of the Kettner channel is typically set 2 times the average true range above the EMA, and the lower band is typically set 2 times below the EMA, 2 times the ATR below the EMA. The bands expand and contrast as volatility, measured by the average true range, expands and contrasts. So kind of like the Bollinger bands, the bigger the bands are, the more volatility. The EMA of a Kettner channel is usually 20 periods, meaning 20 minutes, 20 hours, 20 days, or whatever chart you're looking at. Like I said before, the upper and lower bands are typically set 2 times the ATR above or below the EMA. Although that number, known as the multiplier, can also be adjusted based off of personal preference. A larger multiplier will result in wider channels. So the larger your multiplier that you set it in your settings, the wider the channel. If the price reaches the upper band, the stock is bullish. When it reaches the lower band, then it is bearish. Reaching a band may also indicate a continued trend. The angle of the channel also aids in identifying the trend direction. The channel is angled upwards, the price is rising. When the channel is angled downward, the price is falling. The channel is moving sideways, the price has been going sideways or consolidating. The price may also move between the upper and lower bands. When this happens, the upper band is viewed as resistance and the lower band is a support. So you have your support resistance, and then you have your support resistance. So this is that middle in between one. The Kettner channel was first introduced by Chester Kettner in the 1960s, and in the 80s a new formula was introduced that used the ATR, and the ATR method is commonly used today. So as you can see, these indicators are just math. It's invented by humans, there's no magic behind it, and it can't tell you anything for certain, but if used correctly, it can help determine trends, reversals, and other great things like that. This indicator is similar to the Bollinger Band. A lot of these indicators are actually very similar to each other, as you can see, but they use different numbers and formulas or different averages. And the Bollinger Bands are just like the Donchian Channels. However, the Donchian Channels use ATR to calculate the bands. Bollinger Bands use standard deviation instead. The interpretation of the indicators are similar, although since the calculations are different, the two indicators may provide slightly different information or trade signals, and what you use is really based off of your personal preference. Just like with candle patterns, what you use, what you're best at, everyone's different. It's really based off of your personal preference, which you figure out by practicing. So lastly, we got the Fibonacci retracements that everyone loves, Fibonacci lines. So in Webull app, you just go to your little indicator area in the top right, and then you go to FibLV. So this is one of the most popular indicators among technical traders. They are based on the key numbers identified by mathematician Leonardo Fibonacci in the 13th century. In technical analysis, a Fibonacci retracement is created by taking two extreme points on a stock chart and dividing the vertical distances by the key Fibonacci ratios of 23.6, 38.2, 50, 61.8, and 100%. So the nice thing about the Webull app is you click it, it does all that stuff for you. You don't have to pick the two lines, you don't have to pick the two extreme points. It does it all for you. It kind of just gives you the lines on its own. If you are not using the Webull app, we do have videos going over how to create your own Fibonacci, based off of, doing what I just did by making the points. But I recommend using the Webull app. The Webull app, you just click this button, the FibLV button, and it does it all for you. So what does Fibonacci and all these ratios and all these numbers mean in English or in common terms? Well, as you see in the picture, the Fibonacci bands have a bunch of different lines, the middle one being the blue line. What you're looking for is for the price to keep pulling back to that blue line. The top orange line will be your resistance, and the bottom orange line will be your support. You can also use the orange lines individually as supports or resistances, so as smaller supports and resistance, but typically that blue line is where the price always gravitates back to. So if a price is between two orange lines, the bottom one can be a small support, the top one can be a small resistance. Otherwise, you can use a blue line, the upper orange line, and the blue line and the bottom orange line as your support and resistance. So like I was saying before, these indicators should not be used alone. Think of candles as being your sense of smell and indicators as being your sense of touch. Your nose alone might be able to tell you that you are in a garden. You might be able to use your sense of touch to feel the flowers around you. But unless you use them all together along with your eyes, which in stock trading terms, your eyes is like doing due diligence and having a plan, as well as a community to fall back on, then you won't be able to know for sure that you're actually in a garden or not without your eyes. You won't be able to know for sure. If you're only using your nose and your sense of touch, well, then you wouldn't know that you're actually standing in a patch of poison ivy. So if you're using your eyes, you'd know that you're actually in a patch of poison ivy, and you would know not to touch the poison ivy. If you only use one indicator, you're gonna get poison ivy. You only use some candles, you're gonna get poison ivy. Even if you use only indicators and candles together, you're probably still gonna get poison ivy. But by using your eyes as well as your nose and your sense of touch, you'll be able to avoid that poison ivy. So our eyes is being a part of that trading community, being able to use the news to your advantage, having a plan, knowing your trading psychology, doing due diligence, and just learning, continuing to learn, realizing that there's always something to learn. And only with all that combined with candles and indicator knowledge will that help you keep you out of the poison ivy or a red account in the long run. So for those of you who are new to PBU, you found the right place, but I highly suggest waiting a month until the classes reset so you can follow along live. I know charting is fun, everyone wants to start out with charting, but I definitely recommend starting from the beginning. For those of you who have been with us in PBU since the beginning, first of all, thank you so much. You guys make PBU amazing. This community is just the top community in trading as far as I'm concerned, and I've been in a whole bunch of them. This truly is a wonderful community, but we also make sure to complete your quizzes. The test is in 3 weeks, and if you do well on all those quizzes and the tests, then you will become a part of the first ever graduating class of PBU and the only PBU class of 2020. So make sure to check out the prior classes if you haven't caught up already. I know it's tempting to start off with the charting classes or the indicator classes, but you'd really be doing yourself a disservice if you do that. We reset in a month. You'll be able to follow along live and be a part of the live streams then. But for those of you who are cut up, we'll be going over moving averages tomorrow, and next week we'll be going over some other great indicators. As you can see, some indicators can show you more than just one thing. We went over moving averages briefly today when it comes to finding support and resistance, but we'll also be going over as far as trends, reversals go tomorrow. We went over Bollinger Bands and how they show support and resistance today. So these indicators aren't a one-size-fits-all type deal. Everyone uses them differently, and as far as the settings go, for the indicators that I went over, I personally use the default setting for all the indicators I went over today. We did not have a quiz last week. This week we will have a quiz, or double points, going over what we went over this week and last week. Tonight's homework is going to be to find an example of a support and an example of a resistance using any of the indicators that we went over during today's class, and your support and resistance indicators that you use must be different indicators. It does not have to be the same chart though. And post your homework in the PBU charting channel. I can't wait to see your responses to the homework. You guys posted some awesome candle patterns last week. You posted some amazing trading plans the week before. So tomorrow we'll be going over the EMA and the SMA, but until then, I hope that you all make some bread.